Hello all, welcome to the third episode of Direct Stock Investing series. Are you someone who is worried about the recent market correction? If you see, Nifty had fallen around 3.5 to 4% in the last couple of days, and it had fallen quite some points from the all-time high, and I'm sure that many of your portfolio might have hit by that. So this is the right time actually to see that, to learn about the basic understanding or the basic principles of direct stock investing, because that will give you enough confidence to learn how the stock market works. And even if a small correction of around 10 or 15 percentage happens in the index level and also in the individual stock level, it might not hurt you mentally. So it will give you good confidence on the way, on the journey of your investing. So I would suggest you all start watching this series, because this will be an in-depth series where we will touch upon from the scratch. I have already done 2 videos. Hope you might have seen that. And going forward, I will be covering a lot of concepts around direct stock investing. Having said that, let's start today's topics. So today I will cover few points regarding how a public company reward their shareholders. In the last video, I talked about listing. So right now we are talking about a company named ABC, which is a hotel company, hotel business. They expanded a lot. They had multiple branches, and they listed in the stock market. And last episode, I talked about how an IPO happens, what is a stock exchange, and how retail investors can buy stocks through broker, right? So in this episode, we'll cover basically 4 points around rewarding the shareholders, how a company reward the shareholders. So number one thing is, so if a company has a lot of profit, they usually distribute their profits in the form of dividends. That's the first point I want to discuss. Dividend. Dividend is nothing but when a company, whenever they publish their quarterly results or annual result, if they have excess cash available, they will reward that money to the shareholders. It's a kind of building trust among investors, so that people can understand that the company is doing well. They have enough cash flow to reward the shareholders and investors. Many companies do that. Some companies may not distribute the cash in the form of dividends. Such companies, what they will do is they will uh, redistribute that money into their business for further growth. Say, for example, in the hotel business case, they can do in a way that they can invest that cash for opening new branches in different cities, and they can do maybe focusing on online business. They can invest into R&D or all sort of things. So some companies, they will not distribute the cash in the form of dividends. They will invest into the future growth. So if you see the major tech companies in US, until recently they were not paying any dividends. Say, for example, Google, Amazon, or all those kind of tech companies, they were not giving any dividend, but instead of that, they were putting those cash into the business. So if the profit is increasing every year, right, automatically the share price will also improve. In that way, the shareholders value, or the company is indirectly rewarding the shareholders. So yeah, that's the purpose of dividend. If you want, or if you have more money in your balance sheet, you can reward the shareholders in the form of dividends. Second point that I want to discuss is share buyback. What does that mean? Buyback is nothing but the company itself buys the share from the public market. They will fix a price. Basically, say, for example, let me talk about why a company is buying back their own shares. Then I will talk about the price. if the company feels that in the public market, in the stock market, the price of the stock is not justified as per the growth of the company feels that the stock price is undervalued. In a way, they want to reward the shareholders by fixing a price much higher than the market price. Let me give you an example. Recently, Infosys had done a share buyback. In the stock market, Infosys was trading around the price of 1500 to 1600. Then what company did was they came up with an 18,000 crore worth of share buyback, where the company fixed the buyback price as 1800 rupees for one share. So it's a premium, right? The actual value of the share in the market is between 1500 or 1600 at that time. It happened in last November. But the company said that they are going to buy back the share from the shareholders and investors at a price of 1800 rupees. So suppose you bought Infosys share at 1500 rupees and bidding for the buyback, and the company accept your bid, then you will be getting rupees 1800 per share, basically 300 rupee profit for one share, right? And yeah, there are certain criteria. If you bought a lot of shares, and there are less chance that all the shares will be bought back by the company, because what they will do is they try to reward all the shareholders. So if you are keeping 100 shares and I am also keeping 100 shares, like that, so many people will bid for the buyback, right? So they can't buy all the shares, then it will exceed the 18,000 crore. They can maximum purchase 18,000 crore of worth of shares at a price of 1800 rupees. So what they will do is they try to include maximum shareholders and purchase from different set of shareholders. So that's what happened recently in case of Infosys. It's again a way of rewarding shareholders. One, company feels that the stock price is undervalued in the market. Two, rewarding shareholders. Three, again, it shows that the company has immense faith in their cash and in their business. It's a good sign for investors also. Like, company has good faith means you can confidently invest into that company. So that's what we call as share buyback. Hope it's clear, right? There are a couple of points that I want to discuss here. The third point is stock split. So let me go back to the first video where we talked about briefly about face value of a company. So in that video we discussed the promoter, the owner of the company, put 1 lakh rupees and he has divided the shares into 10, right? Let's do an ulta. So what we are mostly what the company do is that if the share capital is 1 lakh rupees, that means the promoter had put 1 lakh rupees into the company, they will keep the face value of one share as 10, meaning that's the price of one share, 10 rupees, and there will be 10,000 shares, each having a face value of 10, right? So 10,000 multiplied by 10 is 1 lakh rupees. So 10 will be, most of the companies will fix face value as 10 for accounting purpose and taxation purpose and all sort of things. So then from there the share price start quoting more and more, depends on the valuation of the company. So suppose the face value is 10 and the share price is trading at 40, we call it as premium. The share is trading at a premium compared to the face value, right? So what do you mean by share split? Suppose the company had IPO'd and they are trading in the public market, there will be a lot of shares, right? I mean, after a point of time, many investors might have come and the company had to create more and more shares. Mostly there will be crores of shares trading in the public market. And the face value is 10 means the company will split that face value as per the ratio in which they are doing the share split. So if they are doing it in 10:1 ratio, that means the company will split one share having face value into 10. then what happens? The price of one share will become 1, meaning the face value becomes 1. It's a little tricky area. I hope it's very clear. So one share face value is 10. Then the company splits the share in the ratio of 1:10. Then the face value, which is 10, becomes 1. Simultaneously, what happens? The number of shares will become 10, because we have to match that math, right? Here, one share face value 10. Now face value is 1, number of shares become 10. There is no change in the final outcome. It's just that the face value is reduced to 1. Why company do a stock split? Mostly because it will increase the liquidity. The number of shares available in the public market will be more. So more and more people can buy the shares. The liquidity will be more. Buyers and sellers will be more. Right? In a way, it's not directly rewarding the shareholders, but in a way, it's good for the public market trading. And the last point, I hope the share split is clear. If not, please comment below. I can explain it again in the next video. So yeah, and the last point that I have to discuss is bonus issue. It is quite similar with the share split, but in the bonus case, what the company do is that, say for example, again here also ratio will come. If the bonus is issued in the ratio of 1:1, if you are holding one share, you will be added with one more share. Here also what happens is the price will be changed accordingly. Final value of the company will remain same. The only thing is more shares will be made available in the public market. For example, one company's share, I think recently Reliance had done a bonus issue where at that point of time Reliance was trading around say 3,000 rupees. They announced that they are doing a bonus issue in the ratio of 1:1. That means what happens? Every Reliance shareholder will get one additional share, but the price of the share will become half. Hence, you will be having two shares, but the price of Reliance share earlier it was 3,000 rupees became 1,500. So eventually 2 shares of 1,500 is again equal to 3,000 rupees. The final value is same. It's just that the number of shares became more and the stock price became less. This is also somewhat related to increasing liquidity, and it has nothing much to do with rewarding shareholders. But what happens is whenever this kind of corporate action comes, people tend to buy more shares, thinking that the share price tend to rise a little bit. Historically, that had happened, but there is not a big change in terms of the value of the company or the value of the share. So dividend, buyback, stock split, bonus. These are the 3 topics I want to cover in today's episode. I hope it's very clear. So now we have reached a point where we understood the basic fundamentals of a stock, a company, how it is listed on the stock market, and how a company can reward the shareholders, and etc. Right? Starting from next video, probably we will talk about the financial ratios of a stock, mainly the ratios, the market capitalization, P ratio. All these ratios are extremely important before choosing a stock for investing, right? Especially for long-term investing, value investing. I suppose from next video onwards, I will start talking about that. Hope you are liking my content. If yes, do subscribe and share to people who are interested in stock market and investing. Stay tuned for the next episode. It will be coming shortly. And if you have any suggestions, please feel free to comment below. So looking forward to that. There are a lot of things lined up in this series. So yeah, I'm very excited. See you soon. Till then, take care.